Everyone asks the wrong question. Will the market go up? That question is noise. The only question that matters is simpler and harder. What am I being paid relative to the safest alternative, after inflation, after taxes? If you cannot answer that, you are not investing. You are guessing. Your portfolio is not the market. It is a cross-section of a vast institution. Prudence begins with one discipline. Know the long history, not as trivia, as calibration. Over the last century, the market moved through repeated bull and bear cycles. The long arc advanced, but the path was composed of extremes. And those extremes were not random. They were periods when the relationship changed between three forces: prices, earnings, and dividends. That relationship is what you are buying. Not the headline, not the story. The relationship. History is not predictive, but it is constraining. It shows which relationships eventually fail when prices drift too far from earnings and cash flows. Most investors look at one number, P/E, but a market can look reasonable on P/E and still be unattractive. Because P/E is not a standalone verdict, it is only half of a comparison. The comparison is what equities implicitly yield versus what high-grade bonds explicitly yield. When that ratio worsens, the entire level of the market changes meaning. There was a time when dividends on stocks were meaningfully higher than bond yields. Then the relationship reversed. Bonds began yielding more than double what stocks paid in dividends. And when you include high-grade bond yields, a market that looks acceptable on a 3-year PE can still be judged as not attractive for a prudent investor. Not because prices cannot rise, but because the compensation for risk has thinned. This is the first law of market levels. A level is not a number. A level is a yield gap. Valuation is never absolute. It only exists relative to available alternatives. When safer claims improve, risk migrates silently into equity prices. Now the second law. Return is not a percentage. Return is purchasing power. A decade can look profitable in nominal terms and still destroy real wealth. There was a period where stocks delivered an average annual nominal return around 6.5%. At first glance, it looks like success. But inflation ran higher, around 8.6% a year, and it erased the gain. If you grew 6.5% while your currency lost 8.6%, you did not compound. You were diluted. This is why stocks protect against inflation is not a rule. It is a belief. And once governments issued bonds indexed to inflation, stocks were no longer automatically the best simple tool for investors who fear rising prices. A protected claim exists. The baseline changed. Inflation rarely looks like loss. It looks like stability with erosion underneath. Nominal gains can coexist with real impoverishment. In the long run, the market cannot give you magic. It can only give you components. Component 1, the cash it pays you today. Dividends, distribution, yield. Component 2, the growth of earnings over time. Component 3, inflation, which is not wealth, it is renaming. A practical identity follows. Future returns are largely the sum of current yield plus the growth that can realistically compound it. You can argue about the decimals. You cannot escape the structure. If current dividend yield is low and long-term real growth is limited, there is a bound on what the market can sustainably deliver. If returns exceed that bound, the excess did not come from productivity. It came from re-rating. people paying a higher price for the same underlying stream. Re-rating can happen, but re-rating is not income. It is a transfer across time. This is not a theory. It is an accounting constraint. Returns can shift across time, but they cannot be created from expectation. This is where investors commit the most expensive error. They confuse quality with price. A company can be excellent and still be a disastrous investment if the price already contains perfection. In one famous episode, the market crowned a set of untouchable favorites. One of them carried an extreme valuation. Then the cycle turned. Its P/E collapsed from around 64 to about 15. In inflation-adjusted terms, the loss was brutal. And even decades later, an initial overpayment was not fully repaired. Time does not automatically heal overpaying. Time only compounds what you actually own, a yield and a growth rate. If those are thin, time compounds thinness. Time is neutral. It has no corrective intent. It only compounds what the initial price already embedded. Your return is not market return. Your return is after taxes, after inflation, after the rule set of your jurisdiction, and rule sets are not omniscient. Collective choice has a hard limit. You cannot design a perfect decision system that converts individual preferences into a coherent social ranking without violating at least one basic fairness condition. So, policy oscillates, trade-offs rotate, priorities invert. That instability is not a political comment, it is a mathematical constraint, and your yield gaps move inside it. Taxes and rules are not external variables, they are structural claims on returns. Ignoring them does not remove their effect, it only blinds the forecast. Add borders and it intensifies. Trade policy is a strategic game. When countries act independently, they can land in a stable outcome that is worse for everyone, because each side has the incentive to choose protection. That is why agreements exist, to escape the equilibrium. Now add the currency regime. Inside a monetary union, regions cannot adjust via exchange rate changes, so when shocks hit, adjustment shifts to wages and prices, labor mobility, or fiscal action. These mechanisms decide whether earnings compress, whether unemployment persists, whether margins survive. And therefore, they decide your equity yield and growth path. Global markets coordinate through constraint, not harmony. When coordination fails, adjustment shifts rather than disappears. Finally, the safest alternative is not a philosophical idea. It is engineered. Deposits are protected because many savers cannot evaluate bank risk. Protection has a coverage limit. It has a reimbursement timeline. It is funded by contributions and, if needed, extraordinary levies. That architecture creates the baseline yield that competes with equities. When the baseline is credible, yield gaps compress. When the baseline is doubted, yield gaps widen fast. So you do not merely hold assets. You hold the credibility of the safety net. Safety is conditional. It depends on credibility under stress. When confidence weakens, repricing is abrupt, not gradual. Prices move, gaps explain. Respect the yield gap.